with your weekend edition for this Sunday, October 11th, 2020. Now, going forward, I'm probably going to go back to my schedule of recording these, ideally Friday afternoons, early Friday evening. Again, I wanted to finish up as the fall came on, all my chores at my home. I live right downtown, but yeah, I have a home downtown. And you got to get it done just as though you were in a suburb. You got to get all your work done, and I love doing it. It's a break for me from as much as I work on the futures market. So it's fun. So if you watched the news, you can see that the questions were, of course, how did the president flip-flop from Tuesday back on to a Friday, that he wants an even bigger relief package the Democrats or Republicans want. And he said on Rush Limbaugh's show, I have switched gears, I have flipped around. The problem is his own Senate, that the Republicans control, probably won't agree. The good is he doesn't need all the Republican senators. How many Democratic senators will vote with him? So let's assume he lost 5. Probably going to get that easily from the Democrats. Okay, so if the bill is brought there, if they can get one done, that could happen. If they say it'll take 2 weeks to draw a bill, not if they really want to get it done. I don't buy that at all. We'll see. Then the other thing is his COVID case. Does he or doesn't he? And I'm talking the president. Is he still infectious? His doctor says no, but on the news media today, nobody seems to want to believe that, which is amazing to me. If your doctor says no, and he's the national doctor for the president, I would assume it's no. Then, of course, we're going to have reactions in Europe. China week the golden week is over, so now the markets start reacting. So let's go to the chart action. What we did recently over the past month and a half was we filled the gap in the chart and we've moved back to the upside. You almost can see on the XLK, the tech sector, where you're caught between 127.50 and just under the 110 area, and you've climbed back in about halfway between the two. In terms of a chart pattern, you have a higher high and a lower low. That is not a trend. When you look at moving averages, you hear me say to you continually during the week, the chartists like to look at numbers that give them a neutral zone. I believe the 18-week moving average of closes is that number. People have asked, could it be the 19, the 20, the 21? The answer is yes. I use the 18. I have plenty of reasons why. It's called 50 years of charting, using them all, and I have found that I'm comfortable with this. Are there services out there that can optimize which moving average? They can, but when they optimize, remember, it's a lagging indicator, then they're going to change you in front going forward based on what happened in the past. It may not work anymore. I came to the conclusion, I don't have to be that exact. It hit a support zone, and that was a corrective move off a bigger uptrend that took the market out of the uptrend, but it never did put it into a downtrend. Why? Because you never closed under the 18-week average. Should you right now get back under a close under 111.09, right now, this week, I would turn bearish. Why? I would have lower highs. I've already got the lower lows, and I'd be under the 18-week average. That's what it would require. What about in terms of Bollinger Bands? So if the market continues up after ending this correction, I'm going to look for wherever this Bollinger Band comes in. Currently, it's 124.16 as the resistance point, as I did back here and here. Why not? The market trades within it 95% of the time. If you're the one that's playing, hey, it's going to stay out of that, I'm in that 5% range, it's going to keep going, you probably lose. That doesn't mean that you're bearish. It just means the market's running out of that upside momentum at that point in time. In terms of momentum in the market had been pointing down. That ended. You can see it. And now the market is flat on the momentum. It could turn up this week if the red line jumps over the blue. So I'm willing to say that the market finished a corrective move. It could re-enter it if you close under 111.09, barring that resistance 124. When I come to XLI, you never did even make it to any of the moving averages. And there was a big cluster of them we had talked about there. You have a pattern of a lower low, higher high. Again, no trend. Momentum never lost its upside. It kept the market from getting down there. And I think there's a lot of money that was waiting to buy this index, this particular move right here, had the market wanted to come down to it, and it didn't want to come down to it. When we come over to XLE, still in a downtrend. The energy sector's got a problem, and it's had this problem. Lower highs, lower lows, been running the lower Bollinger Band. Now, if you see the red line jump over 20 this week, it's a pretty good sign that the downside has worn itself out. That does not mean it turned bullish. The most you could do on this chart is end it. You cannot start a bull campaign even if you shot up to 41.38, because you'd end up with a lower low and a higher high. In an uptrend, you get higher lows, higher highs, and I have to be over that 18-week average. So I have all the reason that the market moved to the right-hand side of the black line, the Bollinger Bands. You only stay out of them. Only stay out 5% of the time, and each time you get consecutive closes under them, you shrink that 5% away. QQQ. Again, we started looking right here as this market lost its upside momentum. Watch this. And we started saying, okay, you've broken through this low. You're going maybe to that 18-week average. I said maybe. And that's where I expect the pros to hold. If you're a subscriber to my Spider ETFs or my futures, it's exactly what I was saying. Not here do I do that the same way I do in those. Now what am I saying? Well, now the market's in the bounce phase, all right? You've ended the downside momentum. If it can continue a rally, 296.66 is my upside target, and I think the money, smart money, will take something off the table. That is going to be a rally from 260 if it got there, 36 some odd points. That's a heck of a rally. It's about 15%. Why not? When we come to the emerging market ETF, as I said, I thought it was going to be supported by all these moving averages, and it is. Now, don't get me wrong. You've got the 200 over the market, but you have the 100 and the 18 under. And what you did is you came down to those, and each time you've bounced away from the 100, you fought at the 200. That's the game. The market is not trying to stay under the 18-week average. Momentum is turning back up. On weekly charts, I don't look to see if the momentum is getting overbought or oversold. It's up, down, or sideways. And I can make an argument that if you get to 66.50, that'll be a resistance zone in the market. Seems to me that's what it wants to do. GLD is still a market in a corrective down move. It did not enter a bear phase. Why? Because it never closed under the 18-week average of closes. It did get the pattern of lower highs, lower lows. It also got the pattern where it lost its bullish action sideways over the 80, and then it started turning down, calling for a correction that might go to the line in the sand, that 18-week average. It's just what I was saying on my subscriber videos as well. And that's where I think the smart money, and this is what I said in those videos, the long term, I don't want to call them smart. Let's call them long-term traders. We're stepping in and buying that market. That's what I think occurred. Now, what I don't like about the long-term trader is you buy, and then what do? Because they're long-term, they don't care. They're looking at it down the road. The market's going higher in their opinion. I can't trade like that, but maybe you are one of those traders. In GDX, I got a short-term, buy signal in this all of a sudden. Until this week's low is taken out, this is the first buy signal in months that has come in. Why? I've got higher lows, higher highs. I have the market over the 18-week average. And at the very least, I think when we reopen on tonight, Sunday night, we're going to see momentum is minimum flattened out. So that's what I'm looking for. Let's assume it goes up. Maybe the 4,500 zone, the upper Bollinger Band. Where is this trade? No good anymore. Under this week's low, in my opinion, of 31.22, you have an outside week up. You have no business taking that out. If you do, I can make an argument wherever this lower Bollinger Band comes in is going to be a potential target. SLV did not do the same. SLV's got lower highs, lower lows. It's more like gold itself, the GLD. It hit that 2045 number, and it certainly bounced away from it. It's up $2 from that zone. And first time it hit it, I said the same thing. I said, folks, this is where the long-term boys are coming in. And they will light their candles. And yes, I did go to Notre Dame, and I have candles. I've lit them in my office. So you might say, Ira Epstein, yeah, don't worry about that. I like all the gods out there I need help from. So as you look at the market, right through there. Then TLT, bearish, even in the face of the Fed saying what they're going to do. And I realize that the market might be trading between a 50 basis point and an 80 basis point move in the 10-year notes. I see that. But this is the area that I think that the pros took money off the table from the bear side. This week, when you hit that 18-week average, time to come out. First challenge of it, you'll hear me say this over and over and over. That doesn't mean you can't get back in. You can. And there's ways to jump on that, because if you get an embedded reading on the dailies, away you go. Use the weekly and the daily charts together. Next, we come over to FXE. So in FXE, unlike the dollar index, you've broken, never did get to these key averages. And that's interesting to me. The question is, to break that pattern, you got to get over 111.93. It looks like it's far away. It's not. It's all of 65 cents away. So that's not very far. Momentum is flattened out. You've got bias up, but the trend down. Let it do its thing. Last jets. Obviously, it's come to life. Why? It's not that more planes are flying. I think you would agree with me on that. I don't think that we have more people flying. I think you'd agree with me on that. But there is a $20 to $25 billion relief package that one way or the other they're going to get. Whether they get it in front of the election or right after, they're going to get relief, and the market doesn't wait for it. The market says they're going to get it. They're not going to let airlines fold. 30-some-odd thousand people already on furlough, election year, and whoever wins, they're going to try to get this passed through to get some relief to a big need for this. You do realize this industry will come back the moment we have a vaccine. Same things happened already with the cruise industry, but that was more political. President needs Florida, goes down for a campaign, and suddenly out of nowhere, October 30th, the cruise ships can go again. Would you go on one? I wish you the best. You're not getting me on that. So you look at it at this point, still friendly, might be headed towards that upper Bollinger Band. I talk about this and a lot more in my combo packages. Now let me explain what a combo is. We get a trading day, and out of that trading day, the market finishes Chicago time, 3 o'clock, New York time for the ETFs. By 4 Chicago time, I'm recording a daily ETF. Not this review you see here on YouTube, but for my subscribers. Then at 5:40 in the morning, I start a recording for the futures traders. The two tie together. Come on, DIA, SPY, they all rely on what the futures are doing. Your energy sectors, I can go on and on. You tie these together. Here's what I think you should do on the ETFs. Here's what you should do on the futures. Now, futures don't have items such as Canadian gold miners, GDX for us. I can go on and on of the things it doesn't have. Via spiders and ETFs, you get smaller sectors in there. But I cover everything. I cover 40 charts with specific buys and sells. I cover, now I'm up to 37 ETFs for you. I cover all the main areas, as you can see here as well. I give you a game plan. That plan lasts approximately 20 minutes for each one of these. So when you get them, what you're looking at obviously in this is, what is he talking about? What's he got going? The cost, $16.90 for 30 days. Not expensive. You can subscribe to either one. Go out and buy an advisory service. There's very few of them out there for $16.90, giving you 20 minutes of charts on each package every day. Then on the weekend, all weekly charts, just for you, not for the people on YouTube, specific buys and sells. And I use this YouTube that you're seeing as the feeder into those. If you think I'm good here, I'm much better there. How do you get it and how do you find out? Go to our website, under the word research. You might want to look at our charting course. That's under education. I'm Ira Epstein. You have a great weekend. I'll see you all tomorrow.